Two of the main things we talk about here at Nomad Capitalist are, number one, find ways to legally reduce your taxes, keep more of your own money, put it back to work for you. And number two, be diversified. You never know what could happen next. If we can put those two things together, that's a win. And I'm always looking for ways to merge the different tenets of Nomad Capitalist. So today I'm going to talk to you about two tax-free diversification opportunities to where you can put your money in other countries, in other currencies, and do so in a very tax-friendly way. And for those of you who want to know about Bitcoin, I'm going to come to that at the end, but I'm going to talk about two different, what are for most people, foreign currencies and how you can use those to actually earn higher yields, diversify into other currencies, and how that works. I'm talking about the Singapore dollar and the Hong Kong dollar and their respective markets of Singapore and Hong Kong. Obviously, a lot of stocks in Hong Kong that are based on Chinese companies have gotten beaten up in the last year. Some people are looking for a dead cat bounce. Some people are looking for a larger bounce in that market. Singapore is a market that is much more staid. It's almost boring. People in Singapore, younger people, say that investing in their own country is kind of a boomer mindset. And yet if you're looking for some kind of tax-free yield, then these two currencies and these two countries can offer a unique opportunity that you wouldn't find in the US, Canada, Europe, or Australia and New Zealand. The reason I mention these two currencies is because they are more closely connected to the US dollar than a lot of other foreign currencies are. And so if you hold US dollars and you're concerned about currency depreciation when you diversify, then the Singapore dollar has a sort of proprietary system for how they stay within what's called a monitoring band. So it's not necessarily pegged to the US dollar. It used to be many decades ago. But there's a monitoring band of different currencies. Allies and competitors of Singapore, they've got their own blend of kind of how they keep their currency somewhere around 1.34, 1.35, 1.36 to the US dollar. So think of it as roughly 4 Singapore dollars equals 1 US dollar. That trades up and down. During the middle of the pandemic, I think it went down to 1.44. If you go back 10 years ago, I think it peaked at 1.2. But oftentimes you're in that 1.33 band. I think Singapore likes to keep it there because they want their exports to remain competitive. Hong Kong trades in a very much narrower band. And there is potentially some more risk there depending on who you believe. I know that Jim Rogers, who spoke at our Nomad Capitalist Live annual event, has said that the Hong Kong dollar should just go away and they should peg it to the Chinese renminbi. Bill Ackman has some bets against the Hong Kong dollar because he's looked at in the last year when interest rates in the U.S. have gone up. There's been this very vibrant carry trade of people taking up money in Hong Kong dollars and just flipping them into U.S. dollars and arbitraging those interest rates, often with leverage, to where the Hong Kong Monetary Authority had to step in on dozens of occasions and basically strengthen the Hong Kong dollar. If that's going to be a continued issue, then there are some people who, like Bill Ackman, think that they're not going to be able to maintain that very narrow band within which the Hong Kong dollar trades to the US dollar, 7.78, 7.8 or so to the US dollar. But if you look at historically, I mean, these are two currencies that don't have much of a range within the US dollar. So you have that kind of currency stability, at least historically, if you're coming from the US dollar, which obviously a lot of other currencies cannot claim, even currencies like the British pound. But here's the real thing that makes these currencies and markets interesting is neither of these jurisdictions have capital gains or dividend taxes. And so if you open a brokerage account and you buy stocks in Singapore, not only will you earn a higher yield and you could buy, let's say, a bank stock. Some of the strongest banks in the world, number 12, 13, and 14 in the 2023 list, are the big 3 Singapore banks. They are yielding between 5.5 and 6 point something percent, which is more than you would get from equivalent banks like JP Morgan Chase, which is done very well. But if you're looking for less volatile yield stocks, bank stocks, REITs, all sorts of things in Singapore, not only do they invest in stuff in Singapore, but there are US-focused and European-focused REITs. There are companies that are listed in Singapore but do business elsewhere in Southeast Asia, so Indonesia and elsewhere if you're looking for more up-and-coming companies, smaller cap companies. All these yields, generally higher in Singapore, are tax-free. In Hong Kong, the same situation. And so some of those stocks have gotten beaten up. I've somehow my portfolio has remained relatively unscathed. I have some of the larger banks in China based in Hong Kong. I'm actually up in the last year on those. But the yields, because they got so beat up before I bought them, 8, 9%, which you would generally think is a bit unsustainable. But it's a tax-free 8 or 9%. I mean, some of those stocks got beaten up. The yields, again, I mean, in Asia are generally considered to be higher. In part because, people in China generally don't buy stocks. They prefer property, which of course has gotten beaten up. And so there's a whole question of, where are Chinese people going to start, putting their money next? And obviously with some of the population challenges, the government wants them to kind of fund private pension plans. There's a whole number of things, being talked about in China, but, yields are stronger there, and they're especially stronger there. And, they're tax-free in Hong Kong. So there's a number of conglomerates based in Hong Kong that have interests all over the world. Some of the mobile companies that are in Europe are run by CK Hutchinson company in Hong Kong. Swire Pacific has interests around Asia, and same with Singapore. You've got even stocks like Jardine Matheson, which trade in U.S. dollars in Singapore, which have interests all over the world. And so if you want some of that exposure with tax, on a tax-friendly basis, obviously the stock that trades in USD, maybe you like that, but it's not a diversification play. I think that there are reasons to not want to keep all your assets in one currency. There's geopolitical reasons. We talk about the U.S. and the increasing competition from whether it's BRICS or any other, alliance of countries, and what's going to happen in the coming decade or two to the U.S. dollar and its dominance, and what are they going to do to push back on things like taxes, and just what are they going to do as they become every year a little bit less relevant. Every year a little bit smaller percentage of the world's reserve currencies are put in U.S. dollars. What's going to happen? What's going to be the political and geopolitical impact from that? Do I want all my money in U.S. dollars? Are there going to be certain restrictions placed on the U.S. dollar that probably would never be placed on the Singapore dollar? Obviously it's harder to move Singapore dollars around the world because a lot of banks are not going to let you bank in Singapore dollars, but you can certainly convert your Singapore dollars in an outward remittance to any other currency that you want. In times of geopolitical chaos, I'd rather hold the currency of a country like Singapore, where it's much more balanced based on not one country, but what's happening in a bunch of countries, and where they're a very neutral country. They don't want to get involved in some of the stuff geopolitically that the U.S. does. That's, to me, a much better currency to hold. And if I can get higher yields on a stock investment, if I can get those yields tax-free, or if I can put that money in a bank, yes, Singapore dollars and Hong Kong dollars, they had the carry trade last year where people are arbitraging the higher interest rates on U.S. dollars. You're going to earn a little bit lower interest. But if that's an opportunity to open a bank account in Singapore, you can, for a couple $100,000, open those accounts in places like Singapore. It is increasingly a bit challenging if you don't know exactly what to do. We help people open accounts there. It's not always easy. You could just keep your money in the bank and earn some kind of interest rate. If you have banks in Singapore, you can buy things like Singapore government debt, savings bonds, for example, right through your bank account that you couldn't buy elsewhere. And so I think that not having any dividend tax, not having any capital gains tax on stocks, not having interest tax on income earned in bank accounts or in government debt, but also, certainly in the case of the Singapore dollar, being more geopolitically detached. In the case of the Hong Kong dollar, with its connection to China, Hong Kong now, perhaps more of a counterplay, right? What happens in the U.S.? Does China go the different direction? I want to be diversified, and so Singapore may be the easier play. It's a more stable play, I think, in terms of just it's a little bit boring almost. The stock market and the banking there, it's boring. But here's the thing that you need to make this all work. You need to be living in a place that's tax friendly. A lot of people have this idea that as long as they just move their money to Singapore or Hong Kong or the Bahamas or Switzerland, that it's not taxed because they think their country works on a remittance basis. There are countries that you can move to as a foreigner and you can get what's called a non-dom tax status, where money that you don't remit to that country isn't taxed. But where you live, you probably don't have that treatment. And so if you live in Canada or Australia or the US or Germany, you can't just put your money in Singapore and not pay tax. You don't just have to move your assets, you have to move you gotta move your tuchus, you gotta go somewhere. You wanna change your country of tax residence. This is what we do, and we help people do it, Nomad Capitalist. Is you want to find a place where you can go and live, where you live does not add an extra layer of tax on top of where you're investing. We call it the tax-friendly quadrant, and it generally applies to businesses where your company is incorporated or where your company does business, but can also apply to investments. And so no matter what your tax status is, if you invest in a U.S. dividend paying stock, that dividend's always going to be subject to some level of taxation. And it's actually going to be taxed higher in a tax haven than in a non-tax haven. And sure, I mean, U.S. dividend stocks are fine. But I happen to think that for the geopolitical, the currency, all the kinds of diversification, having some of these Asian countries in there, I heard someone describe it very well, for deep value. If you like some value in your portfolio, just in terms of the equities themselves, and that more conservative approach, and you can get it tax-free, and you get the diversification from whatever, who knows what happens in the West as they increasingly lose their total grip on power in the world. To me, that's worthwhile. Maybe it's not everything you do, but the point is, if you live in the US, they'll say, well, that's great. You don't have to pay Singapore, but you just pay us the whole dividend rate. So that doesn't really work very well. Americans have more limited options. That's something that we help people with. If you're not American, you can move pretty much anywhere you want. So right now we've got an Australian guy. He's moving to Thailand. And so if he keeps those investments offshore and doesn't bring that money into Thailand, Thailand's got a new remittance-based system. We've talked about that in a separate episode, but he can keep all that money offshore. Thailand's not going to tax it. If he leaves Australia properly, they're not going to tax it. We've got a Canadian guy right now who's moving to Malaysia. I happen to think that living in Asia, I do part of the year, it's helpful to see kind of all the growth that's taking place in that part of the world, and that could be wealth positive. But the person moving to Malaysia, they're not going to have any local tax, so they can keep their money offshore. We have had people who've moved to non-dom and lump sum countries in Europe. We've had people move to countries with tax exemption plans, formerly Portugal, now Uruguay, there are others, where you're exempt for a certain number of years from paying taxes on anything earned overseas. So there's like 31 or 32 different countries we've helped people move to. There's something for everybody. You probably didn't think many of them were tax friendly, but if you move to one of those countries and you don't pay tax on any of your foreign income, or in a couple of cases any income at all, and the jurisdiction that you're investing in not only gives you that diversification, currency, geopolitical, you're building more neutrality in your portfolio, well then you're tax friendly, the jurisdiction you're investing in is tax friendly, and potentially you're getting double the yield at zero tax. That could triple the actual output, plus you're getting diversification for free. Now, Hong Kong is looking for someone who wants that connection to a different geopolitical part of the world. They're looking to reopen their capital investment entrance scheme, basically a residence program where if you buy, they're talking about $4 million US in Hong Kong stocks and shares and potentially bank deposits. They'll give you a residence permit. Not good if you're running your company in Hong Kong, if you've got a Hong Kong company, because then that makes it taxable. But if you're an investor, you could even get a residence permit and potentially even a passport if you wanted it out of the deal. Singapore, potentially a residence if you're a very wealthy family office, you could do that. So you're getting a lot of different ways to diversify potentially, from other currencies to lower taxes to higher yields to geopolitical safety to even residence permits, all from saying, hey, I don't want to keep my money in my home currency anymore. And I'll tell you, as someone who grew up in the United States, I'm not saying there's not still potential in the U.S. stock market. I own some U.S. stocks. They don't pay as high of a yield. Some of them grow. But the ones that don't do as well, you got to cut the losers sometimes. I just think that every year the U.S. loses a slice of its dominance in the world. And I don't think that's going to collapse overnight. But I wonder at what point do they retaliate? Could be capital controls, could be crazy high taxes, especially if you live there. I'd rather have another place to live, and I'd rather have more tax-friendly, more neutral investments. Those are two ways to do it if you're just dipping your toe in. Now let me pay off my T's on the Bitcoin point, and this could apply to any cryptocurrency. If you hold Singapore dollars in a bank outside of Singapore, it's still taxed based on where you live, so the currency doesn't dictate it. But obviously it's more easy to keep Singapore dollars in your Singapore bank account. Stocks that trade in Hong Kong dollars trade in the Hong Kong exchange generally. Bitcoin, cryptocurrencies are not tied to one country, so therefore it's easier to simply make a move because the currency itself is not tied to one place. And so if you're in Bitcoin and you've done very well in your portfolio, perfect opportunity for you to leave your country. We've done plenty of episodes on this. You exit your country. Now, if you have appreciation in Bitcoin, because it's treated a little bit differently, there may be an exit tax if you have a big capital gain. That's one thing we do help people with, but is figure all that out. But the sooner you get to another country, that's tax-free or tax-friendly to Bitcoin or as a tax exemption or whatever else. The non-dom countries we often talk about aren't as good for Bitcoin and cryptocurrencies in many cases, but find a tax-friendly country that works specifically for cryptocurrency, and obviously you can then just enjoy all those benefits. And so if you prefer diversifying into a crypto than into another fiat currency, that can also work, but you want to realize it's going to be a little bit different game, and that's why it's so important for someone with money in crypto to leave while the prices are lower than what they bought at, because your country is going to take that one final bite at the apple on any capital gains before you leave and go to tax-friendly pastures. All stuff you can learn about with us at nomadcapitalist.com/apply, but for those who prefer Bitcoin, potentially even easier to diversify.